The year is 2019. You're looking to beat the market. So, you backtest. Hedgefundie's excellent adventure. I am young and willing to take risk. Let's use leveraged ETFs and rebalance them based on the idea that bonds act inverse to stocks. And let's backtest this extensively. Since 1985, this portfolio has outperformed the S&P 500 by an unbelievable margin with equal downturn. Over the long run, long-term treasuries and the S&P 500 have had a correlation of approximately 0. Obviously, the problem with a 40-60 portfolio is that it delivers relatively conservative returns. The solution is leverage. What are the risks of your strategy? The main risk is that the S&P 500 and long treasuries crash together in the same short period of time. In the past 30 years, this has not happened. Flash forward 3 years, this system is down over 70% from its all-time high, and it is now unchanged across the last decade. So, what happened? 30 years of backtests, and it collapses almost immediately. What gives? Well, as they say, if it were easy, everyone would do it. And backtesting is rather easy. Go to portfoliovisualizer.com, hit backtest portfolio, input variables that have done well over the last 10 years, rebalance the portfolio monthly, compare it to the S&P 500, and boom, you've beaten the market by a factor of 10. Let's try again. XLE at 50%, semiconductors at 50%. Wow, we've beaten the market again. Okay. Some of those are a bit obvious. Obviously, if you just bought the best stocks, you'd outperform, and no one would think you're a hero for suggesting such. And that makes our original example a bit more interesting, because the original example made more sense. Stocks trend higher over time, and for the last 40 years, bonds trended higher over time. And in instances of market decline, bonds either acted without correlation to stocks or with inverse correlation to stocks. So in combining the strategies, you got a portfolio that trended higher over time with lower drawdowns, thus allowing for leverage. The problem is, for bonds to trend higher continuously over time, excluding their yield, the yield of said bonds must decline forever. And as we learned in 2022, that is an unrealistic expectation. But when you backtest over the last 40 years, you come to the conclusion that it is a trend that will likely continue because it has been occurring for so long. But that's not the only thing that went wrong. Throughout the backtest period between the 1980s and the late 2010s, price-to-earnings ratios had been consistently moving higher, in addition to yields moving lower. And price multiple expansion was reasonable given the decline in yields. So in 2021, stocks became historically overvalued with historically low interest rates. And when yields moved significantly higher, but not even close to their historic mean, they applied downward pressure to stocks and bonds alike, leading to the decline in that portfolio over this period. And this is the problem with backtesting. You're looking for outperformance in the past. So what's the solution? 1. Test your backtest out of sample. 2. Try to prove yourself wrong. Let's look at 1 first. So, testing our backtest out of sample. Let's look at the last 3 years, for instance. Over the last 3 years, vol selling and energy has outperformed the market. And if we backtest starting in 2021, we'll see that as our initial portfolio outperforms the market significantly. Now, since this is our sample period, let's change that. Now we're looking at the 3 years prior to our in-sample period. Let's try again. Now we have the exact opposite effect, where our portfolio underperforms significantly. One problem with this is that it's hard to know how long your in-sample period lasts. For instance, the original post was about going long bonds across a 40-year period in which yields consistently declined. So in testing any period against any other period within this 40-year time frame would have looked in sample. And in looking at the 40 years prior, the opposite would have been true, which leads to a different problem, as if that strategy was started and backtested at any point aside from 2019, it would have led to outperformance, as that in-sample period would have continued for many, many years to come. And that's where our second solution comes into play: understanding the trade. If bonds have been trending higher for the last 40 years, alongside stocks doing the same, and we build our thesis on the likelihood of this continuing, we have to understand what that means. And what that means is that yields decline forever. And that, of course, is an unreasonable assumption, especially when you consider that the original portfolio was 60-40 bonds to stocks. So a large amount of the returns actually came from the rally in bonds across the last 2 decades, which came entirely as a result of declining yields. So when yields moved to historically low levels in 2020, it allowed for TLT to decline significantly while being 60% of the portfolio. And while that generally wouldn't have been a huge problem historically, when you pair that with a decline in stocks over the same period, and you're only long stocks and bonds through their levered vessels, you get a 63% decline in UPRO and a 92% decline in TMF. You get a near unrecoverable decline, taking your returns back around a decade. And these are returns that will be very hard to make up considering the leverage decay experienced over this time period, because this strategy is only long leveraged funds. And this takes us back to our original problem, backtesting. It can be useful if you understand the trade. If yields have been declining for the last 40 years, and you've found this strategy that outperforms in this environment of declining yields, you must simply understand that this outperformance only works in an environment of declining yields. So in, say, 2020, when the 30-year yield went as low as 1.19%, the lowest in its entire history, you have to understand that the outperformance you're expecting as a result of declining yields may be unreasonable going forward, as how much further down can yields really go? I just want to say this is not a dig at the OP. It's just a great example of an in-sample backtest being misunderstood as alpha, as in the end, it's all simply a trade. And when the trade is betting that yields continue lower from all-time lows near 1%, it's a difficult trade. That's about it. Consider subscribing.